Imagine that feeling, right? The smell of a brand new car, everything pristine, and then you hear there's a new tax break that might make it easier to afford. Sounds almost too good to be true sometimes. Well, President Trump's One Big Beautiful Bill Act actually puts something like that on the table, a tax break on car loan interest, specifically for new cars. Welcome to the deep dive. Today, our mission is really to pull back the curtain on this specific tax break. We're going to crunch the numbers with you, look at the policy details, and figure out if it's genuinely a game changer for car buyers, or maybe just, a shiny hood ornament. And to help us sort through the hype, we've got insights from experts and reliable sources like Kelley Blue Book, Consumer Reports, Edmunds, Bankrate, and some CPAs too. Let's get started. Okay, so the headlines were definitely splashy. Tax break for car buyers. But like with any legislation, the real story is often, in the details. Let's start with the basics of what President Trump's act actually says about this new car loan interest deduction. What are the core mechanics here?
Right. Well, the basic idea is pretty simple on the surface. You can deduct the interest you pay on a new car loan from your taxes. But, and this is key, it comes with some very specific rules. First off, it's only for new cars. Completely new.
Okay, new cars only, no used cars. That already cuts out a big chunk of the market, doesn't it?
It certainly does. If you prefer buying pre-owned, this specific benefit just won't apply to that purchase.
Got it. What other specifics do people need to keep in mind?
Well, besides being new, the car also has to be assembled here in the United States. And we should definitely talk more about what made in UFA actually means later, because it's not always about the brand name. Financially, there's a cap. You could deduct up to $10,000 in interest each year. But there's also an income limit, or rather a phase out. For single filers, it starts getting smaller if you earn over $100,000. And for married couples filing jointly, that threshold is $200,000. Above that, the deduction gradually disappears.
Okay, so income limits too. And is this something permanent, or is it just around for a little while?
Yeah, that's another important point. It's temporary. It only applies to loans taken out between 2025 and 2028. So a 4-year window. Come 2029, it's gone.
Right. And here's something I think is really crucial, something that could easily trip people up when they're thinking about savings. We're talking about a tax deduction, correct, not a tax credit. That difference is, it's huge for your actual bottom line.
Absolutely huge. A tax deduction just lowers your taxable income. So let's say you're in the 22% tax bracket, right? And you manage to deduct the full $10,000 in interest. That doesn't mean you save $10,000. It means you save 22% of that $10,000.
So which works out to $2,200.
Exactly. $2,200 off your tax bill in that scenario. Now, a tax credit would be dollar for dollar. A $10,000 credit saves you $10,000. So with this deduction, your actual cash saving depends entirely on your tax bracket. It can be kind of a surprise for people expecting a bigger number.
Okay, we've got the rules laid out. Now let's get to the big question, the real numbers. How much does this deduction actually move the needle for the average person buying a car? Is it really shifting the calculation?
Well, you might imagine significant savings, but the reality, according to Consumer Reports anyway, is quite different. For most buyers, the saving is likely to be around $500 a year.
Mm-hmm.
Maybe a bit more, maybe less, but that's the ballpark.
$500, okay. That's not exactly life-changing when you're talking about a car purchase.
Right. And let's put that $500 against the backdrop of the car market itself. Kelley Blue Book data shows this enormous price difference. In June, the average new car price was nearly $49,000. Compare that to the average used car price in early July, just over $25,500.
Wow, that's a gap of over $23,000. Massive.
It is. Now, let's say you finance that new car, and KBB says typical interest might be around $2,000 a year. If you're in that 22% tax bracket we talked about, 22% of $2,000 is about $440 in savings. Let's call it $450 a year from the deduction.
Yeah.
So you're saving maybe $400 this year. How long would it take to make up that $23,000 price difference between new and used?
Uh-oh, I sense a depressing calculation coming.
It works out as something like 58 years.
58 years,
Yeah.
Right, okay. That really puts it in perspective. So given that huge price difference, how much can a few $100s a year really sway someone? I mean, new cars definitely have appeal to warranty, knowing it's reliable, that new car smell. But is maybe $400, $500 a year enough to justify spending an extra $23,000 up front? It seems unlikely for most people. And that's before we even talk about the depreciation trap with new cars. The second you drive it off the lot, boom, a big chunk of value just vanishes, 10% instantly?
Pretty much.
Yeah.
On that average $49,000 car, you're talking nearly $5,000 gone right away. And Bankrate points out it keeps going another 10 to 15% loss each year after that for the first few years.
It's like throwing money out the window as you drive away.
Well, yeah, that's the premium for new. Used cars, on the other hand, have already taken that big initial depreciation hit. That's a huge part of why they're cheaper. You're not paying for that first steepest drop. Of course, the flip side with used can be, potential repairs later on, maybe less warranty coverage. It's a trade-off.
Okay, so used cars avoid the big depreciation hit.
But here's something else that's kind of interesting, maybe even a bit counterintuitive. New car loans often have lower interest rates than used car loans.
Really? How much lower?
Edmunds reported average rates in June were around 7.3% for new cars, but nearly 11%, 10.9% for used.
Huh.
Okay, so if you buy new, you might actually pay less total interest over the life of the loan because the rate is lower, which paradoxically means there's less interest to deduct. So the deduction itself might be less valuable purely because your interest payments are smaller to begin with.
That's fascinating. So the people getting the best rates on new cars might actually benefit less from this interest deduction.
It could work out that way for some, yeah.
So who does stand to gain the most from this? Is there a particular group?
It seems the biggest potential benefit is actually for buyers with lower credit scores. If you have what lenders might call tarnished credit or maybe no established credit history, you generally get offered much higher interest rates.
Right, much higher.
So because you're paying significantly more interest overall on your loan, the deduction becomes proportionally more valuable. You simply have more interest to deduct. Ivan Drury over at Edmunds put it pretty well, saying something like, it actually helps the people in the most need. This stands to benefit you the most. It might be an unintended consequence, but it targets that group more.
Interesting. Okay, let's shift gears a bit to that Made in USA requirement. Clearly the intent there seems to be, encourage buying domestically assembled cars, maybe help U.S. automakers. But what does Made in USA actually mean here, especially now when car manufacturing is so globalized?
Yeah, this is where it gets pretty nuanced. For this tax break, Made in USA specifically refers to where the final assembly happened, not where the parts came from or where the company's headquartered, just the final assembly point.
Final assembly only.
Exactly. And Edmunds found that roughly about 50% of all the new cars sold in the US last month were actually assembled domestically. But here's the twist. It's not about the badge on the grille. You might have a Toyota Camry or a Honda Accord traditionally seen as imports being built right here in Kentucky or Ohio.
Okay.
And conversely, you might have a vehicle from a classic American brand, say Ford or GM, that was actually assembled in Canada or Mexico.
Right. So you really can't just assume based on the brand name anymore.
Not at all. It really messes with those old assumptions about what's domestic and what's import.
So for you listening, how can you actually check if a specific car you're interested in qualifies under this rule?
The easiest way is usually the window sticker on the car itself.
Yeah.
The Maroni label. It legally has to list the final assembly point. You can also use the VIN, the vehicle identification number. There are federal VIN decoders online that can tell you where it was assembled. And you can bet dealers will be highlighting the cars on their lot that do qualify. They'll likely make it pretty clear.
Good tip. Okay, so let's try and pull all these threads together. We've looked at the rules, the numbers, depreciation, who benefits, the Made in USA part. What's the bottom line? What does this all really mean for you, the potential car buyer trying to make sense of it all?
Well, the general feeling among most experts seems pretty consistent. This tax break is probably not a major game changer for most people. Sean Tucker from Kelley Blue Book said it might very slightly privilege domestically built cars, but ultimately they don't think it'll have a huge impact. His reasoning: it's just not a big number, and it's not going to be around for a while.
Not a big number and temporary.
Exactly. And we heard something similar from Miklos Ringbauer, a CPA. He mentioned that the $10,000 deduction cap sounds really good, but the actual tax saving number will likely be a surprise for a lot of taxpayers, meaning smaller than they expect.
So the expert consensus is nice, but not transformative.
Pretty much. So the key takeaways for you, the listener, seem to be this. Think of this deduction as maybe a little cherry on top. If you were already set on buying a brand new car for other reasons, warranty, reliability, maybe just wanting something new.
A small bonus, potentially.
Right. It might save you a few $100s a year if you buy new, if it's US assembled, and if you meet the income requirements. But, and this is the crucial part, It's almost certainly not going to bridge that big price difference between a new car and a comparable used one.
So if the main goal is saving money,
Then a used car, which has already taken that initial depreciation hit, is still likely the much better financial choice for most people.
okay, so the advice really boils down to do your homework. Don't just assume this applies or that it's a huge saving. You need to verify if the specific car qualifies, estimate your loan interest based on your likely rate, and double check those income limits.
Absolutely. And maybe the biggest piece of advice is don't let a relatively small temporary tax break distract you from the big picture. Buying a car is a massive financial decision. Focus on finding the right car for your needs and budget and getting the best overall deal you can, regardless of this specific deduction.
Right. So, summing up, President Trump's One Big Beautiful Bill Act did introduce this tax break on new car loan interest. It offers some savings, yes. But for most buyers, it doesn't really change the fundamental math when comparing new versus used cars. It's a specific benefit with specific rules, not a tide turner for the whole market. Which leaves us with maybe a final thought for you to consider. How much does a relatively small financial incentive, like a few $100s a year in tax savings, actually influence huge decisions like buying a car? Or do the much bigger economic realities, like that massive price gap between new and used, or your own personal budget and needs, always end up being the deciding factors? Something to think about as you navigate the complex world where finance, market forces, and personal choices all intersect.